Gold prices continue higher, and that does provide a little bit of a warning to investors. We're going to talk about that today on Office Hours with Professor Mark Guthner. Hello, everybody, and welcome. When am I going to learn to wait for the bell? Hello, everybody, and welcome. I'm Mike Coe, joined, as always, for Office Hours by Professor Mark Guthner of Rutgers. How are you, Mark?
Well, I'm doing pretty well. I got no complaints. We've been having this warning that the world's coming to the end because of this nor'easter. And fortunately, not very much has happened. So,
Your power hasn't gone out. Actually, that's a good warning. Yesterday, my power went out twice. I'm in the Bay Area,
Yep.
for those who don't know. And yeah, we don't get nor'easters, of course, but we are getting some uncharacteristic weather, or maybe I should say the winter weather is beginning to start. It gets a little windier, a little colder, rainier, and so on. And yeah, our power went out twice. Also, since the last time we had office hours, gold has continued higher. As stocks went up, gold went up. Then Friday, stocks went down sharply, and gold went up. And then stocks went higher again, and then lower again, and gold went up, and then it went up again. I mean, this, to me, is, one of these things where normally we would expect some correlation in risk assets. I'm not saying that gold's a risk asset. Gold occupies a different role at different times. Sometimes it's a safety trade. Sometimes it's a speculative trade. Sometimes it's an industrial trade. What is it now? What's it telling us in your view?
Well, I always think of gold as a confidence indicator. So if people think the monetary authority is going to be behaved, and the government's going to be behaved with respect to fiscal policy, that stocks will outperform gold. And when that confidence starts to wane a little bit, then gold will outperform stocks. Now, the gold has a couple of things going for it now that are systemic. That's like got more than one thing. And one is, and I've been very critical of this, when the war between Russia and Ukraine started. The U.S. and the Bank of International Settlements and the EU froze Russian assets. They had, I don't know, $500 billion of treasury bonds, which they just said, you can't have those anymore. And we're not going to let you trade them to somebody else and things like that. We're not going to let you have access to SWIFT. So hoping to put pressure on their oil selling business. But this is the first time that I am ever aware of, I think, in the history of modern times, where the international financial order isolated somebody from the international finance system. One, in confiscating assets, and two, saying that you're not going to be able to transfer money internationally through SWIFT. And so if you are any country that thinks that someday you might be on the wrong side of, the EU attitude or the U.S. attitude, or the Bank of International Settlements, you might have your assets taken. So they gave people a perfectly good reason to dump treasuries and buy gold. And we also saw a number of countries in the past few years repatriate their gold. So they had gold sitting in the vaults of the Federal Reserve, downtown Manhattan, I would suppose. And they said, we want it back. So they had to pack it up and ship it back to Germany and France and other countries that wanted their gold reserves back. So that's problematic. And two, we see that the political will to be responsible on on the federal budget is problematic. Yes, the Republicans want the budget under control. The Democrats want to spend more. But the real fight is over. Do we run a deficit of 1.5 trillion or $2 trillion? Both are terrible.
Mm-hmm.
And that
So
giving
I
you perfectly good reason to go to gold. It's like they are going to debase. It's just a matter of when and how fast. So we've had a little tailwind. It's a little bit surprising gold has done as much of this because the Fed's still doing a little bit of quantitative tightening. They're letting assets roll off their books. But I have a feeling that is going to come to a quick end here.
I have a chart up that we can take a look at together. Perhaps it's now. I apologize because there's a lot of things on
Yeah.
here, and I want to just let everybody know what it is we're looking at first. But I think it's quite interesting. So to try to make it a little bit clearer, I tried to color code different things. So in red, I'm going to highlight that. So in red is the public debt. That's the U.S. public debt
Yep.
over time. And just so people recognize that when we think about how much debt the government truly has, this is the recognized public debt, which is a little bit different than the net present value of its debt and liabilities.
Yeah.
Because the way the government does its accounting, it doesn't really think about its debts the way people or businesses do. And just to clarify that a little bit, the government uses a cash accounting system,
Yeah.
which means that it does not recognize a debt until it actually borrows the money to pay for something,
Right.
even if it has that liability. So an example is if they have $30 trillion of outstanding healthcare liabilities, that's the net present value, that doesn't show up on the Fed's on their balance sheet
Right.
until they actually have to pay $1 and they've only got 60 cents and they have to borrow 40 cents. So then 40 cents of whatever just got paid gets recognized and rolls into the debt. The total value, the total net present value of unfunded liabilities associated with things like Medicare, Medicaid, Social Security, the amount that is varies depending on it, different estimates, but it's probably in the neighborhood of $100 trillion or more.
It's close. It's
depending on
closer to 200 trillion. Larry Kotlikoff is a professor up in Boston. I want to stay at Boston University, but I'm not sure. He's talked about this for years. This unfunded liability that the
Yeah.
government has. That those are Social Security, Medicare, Medicaid, and other promises the government has made to pay out over time. And some of those estimates are as big as $200 trillion. Now, that is net of any tax revenue that current tax law
So yeah,
exists.
the number I'm citing, the number I cite comes from the more optimistic assessments that some of the government's own agencies
Yeah.
often generate. They have a tendency to underestimate future liabilities, and they have a tendency, in many instances, to overestimate the benefits of potential taxes and revenues that they foresee coming up. So, for example, if there's a sunset of a tax cut, they tend to bake in the assumption that that's not going to get extended and
Yeah.
that sort of thing. So a lot of the accounting for these types of things is a little bit flawed. But let me get through the other things on this
Okay.
chart so we can kind of think about the interplay. Okay, so the red is, I thought red would be a good color for the public debt. So that's the U.S. public recognized debt, not unfunded liabilities. The gold here is, as you would guess, that's the price of gold. In green is the M2 money supply
Yeah.
over time. And down here in white is the Dixie Index, which is a barometer of the strength of the U.S. dollar relative to other currencies. Okay?
Yep.
Now, when we look at this whole thing over this extended period, and I went back to the early 1990s for a very specific reason. Bill Clinton was elected to become president in late 1992. In November of 92. He became president in January of 1993. This was a relatively interesting period. The 8 years where he was president was an interesting period in U.S. politics because the House was controlled for much of that time by the Republicans. Newt Gingrich was the Speaker of the House back then. And they had, I believe, what was called the Contract with America. Isn't that what it was, Mark?
Yeah, it was even more notable than that because the Democrats had held the House of Representatives up until 1992, since the Great Depression. So, yes, the Senate flip-flopped between Democrat, Republican, and the presidency, Democrat, Republican. But the House was always controlled by the Democrats for, 60 years?
Yeah, and what was interesting during this time was that part of that contract was an idea that the government would have fiscal responsibility. And so they ended up with a pay-to-play program. They actually, during that period, they came very close. They missed in the Senate by a vote of passing a balanced budget amendment. As hard as that is to believe. But we're about to see what the implications of that were, because you might be able to see it on this chart, maybe not. But if I shorten up this window a little bit, so let's just go to before the credit crisis. So we'll go to 2005. Hopefully this chart will work and everything will do what I want it to. Let's see. Okay, good. Did what I wanted. Now, notice this line right here, the red line, that this actually starts to flatten out, right?
Yep.
So in the latter stages of the Clinton presidency, you can see that the U.S. debt wasn't growing. And that was because of this pay-to-play. Effectively, what was going on, so in fact, if we look at this on an inflation-adjusted basis, effectively the debt didn't grow really very much at all for the last couple years of his presidency. We actually had a balanced budget. Now, to your point, it didn't address the unfunded liabilities problem, although, to his credit, President Clinton at the time was looking at that issue. He brought in a guy named Jose Pinera. He's an economist. People might be interested. They can look him up. He was the effectively Chile's equivalent, Harvard-educated guy. He was Chile's equivalent to the Secretary of Labor. They had some serious fiscal problems in Chile at the time. And he was brought in to help solve those problems. And they did a partial privatization of their version of Social Security and things like that. In any case, there was a real effort afoot in Washington to actually get the federal fiscal house in order. And let's take a look at what happened. So the debt started to level off. The dollar, seen here, started to go up in value relative to other currencies. And the price of gold fell.
Yeah.
So this makes perfect sense, right?
Yep.
You get your fiscal stuff in order, your currency strengthens, the value of sort of real money, hard currency proxies goes down because you're adding value to your fiat currency in real terms. And now, take a look at what has happened since. We can advance the clock now. We'll go out to, say, 2012 and see what started to happen. Well, this is going to now encapsulate the credit crisis. And what happened? So the pay-to-play rules sunset during the George W. Bush administration. Now, this is the fault of Congress, right? It's not, those rules are set by Congress, not by the administration. But when those rules sunset, it becomes a whole lot easier if Congress can say, oh, we want to pay for this, but we are not legally obligated to go find revenues to pay for it. Lo and behold, it's a lot easier to just give your constituents what they want.
Yeah.
So that's what they started to do, and the debt started to increase once again. As the debt went up, gold went up, the dollar went down, and then you reach into the financial crisis here, and all of a sudden the debt really starts taking off. Now, at the same time that that's going on, this is the Fed balance sheet. So this is money printing. Boom. Now, if you're looking at this first chart that I have here, you're looking at the money supply and you're saying, well, the money supply in 2008 remains relative. It doesn't go up by as much as you might expect. Now, Mark, I remember you did a presentation on this exact issue. So the reason I have the Fed's balance sheet here separately is because normally in a credit crisis, when there's a number of defaults, without intervention, what would happen to the money supply?
Well, it would typically fall because people would default on debts. Bankers wouldn't renew or reduce the amount of debt they renew, so roll over. So they'd pressure people to sell assets and pay down debt and that kind of things.
And this was part of the logic that Ben Bernanke, if people will remember, there was a sort of comical video about an animated cartoon about money printing,
Yep.
and there was a lot of gnashing of teeth about the Fed's intervention during the GFC and what they were calling quantitative easing.
Yep.
Quantitative easing was what some might describe as heterodox. Heterodox being sort of a new and innovative and unorthodox approach. But really it wasn't, because what it was just money printing. And money printing has existed for as long as there's been printed money.
Right.
But I think the logic was, Ben Bernanke's logic was that he had been a student of the Great Depression. And during the Great Depression, there, of course, was a collapse in credit. And his view was that the Fed could have ridden to the rescue by supporting the money supply to offset. And that's essentially what happened here. You can see there's a little bit of a sort of a bump in the money supply, but the long-term trend largely remained intact. Put differently, this huge spike in the Fed's balance sheet, and it is huge, right? So this is right here, $6 trillion, and this is 15. So that's a $9 trillion increase. That's a staggering amount of money printing. But the money supply didn't blow up because that was kind of an offset to the deleterious effects of basically the credit collapse, right?
Yep.
So the money supply can be impacted by you can print money, banks can lend money, the Federal Reserve can buy assets, for example, and create money this way. And so the money supply that was being eviscerated during that time was essentially the private money creation, right? So banks make loans, those loans default, all of a sudden you have the money supply and credit is coming in,
yeah.
And the Fed basically stepped in. So that was the logic, and I think your presentation actually showed that you could explain how much the Fed's balance sheet grew by taking a look at their desire to keep the money supply growth at essentially a relatively constant thing. You had studied that, right?
Yeah, it's something that I recall doing a long time ago, but I don't remember the details of it anymore. It's one of the problems.
I can remember the chart you created.
It's one of the problems of getting old.
Well, you also do a lot of presentations. You're a professor, right? So
Yeah.
you're doing presentations every day.
Yeah.
So, but this was one that I always thought was very
Yeah.
interesting. now we fast forward to the present day, and all of a sudden, what has happened is that, well, first of all, we can see that the Fed's balance sheet then grew again in the 2011-2012 period, and then in response to the pandemic, another huge intervention.
Yeah.
But in this instance, that intervention coincided with a steep decrease in production, result of shutdowns and things like this.
Hmm.
And this in conjunction with massive transfer payments, which increased demand. And lo and behold, if we go back to our first chart, now we start seeing these things happening. The dollar starts to weaken. Gold takes off. The debt takes off. And we get this steep increase in M2 money supply.
Yeah.
And that steep increase in the M2 money supply has not been corrected. In other words, we're not back to the long-term trend. So unlike what Ben Bernanke did in the GFC, we now have M2 that's well above that long-term trend line. And I'm going to try to see if I can put a chart, something in here. There. So that's what it should have looked like. But then we've got this. And all of that is borrowed money.
Yeah.
Borrowed and printed money. And we can see what happened to gold during the same period. Now, the only reason I would argue that the dollar, that's down here in white, relative to other currencies, hasn't been even more eviscerated in the midst of all of this, is that other countries also have fiscal problems of their own. And in the midst of all of that, the dollar is considered a safe haven during times of global geopolitical crisis, and we've had plenty. We've got the war in Ukraine.
Yeah.
Maybe there's, I don't know, a new day is dawning in the Middle East. This is getting the return of the hostages is a huge, and getting Hamas to lay down their arms is a massive win for the world, I would say.
Yeah.
But every big win that we've seen in the Middle East, they have a tendency to be short-lived. I'm hoping this one lasts a little bit longer, but we'll see. What do you think is the next move? This is a really steep and uncorrected move in gold.
It is.
We have a reason to explain it. If we look at the M2, that explains it. But do we need to worry here that this is sort of getting out of policymakers' control? And if we think that, do we get on the gold train, or do we? I've sort of been on the gold train. I should, in fairness, but for people who are tuning in who have not been, what now?
Yeah. Well, I'm not a particularly good gold trader. I've not traded it very well over the years, but the only good trade that I've made is buying silver, I don't know, 30 years ago at $5 and never selling it, keeping them for paperweights.
Yeah.
So what's interesting about silver is here we're all back to $50 for the third time, whereas gold is broken out to new highs. Silver is keeps revisiting the $50 level and getting rejected. We did it during the Hunt brother days of what was that, 1970? Well,
it was the 70s.
70s.
It was,
maybe it's
yeah.
1980. It was right at the end of the decade, I think.
Yeah.
And they tried to corner the silver market, got up to $50, and then crashed down to like, I don't know, $3 or $5. That's when I bought it. Like anything else, I got a little caught up in the big run up. So I think I bought some silver at $25, saw it go to $50, and rode it all the way down to $5 or $2 or whatever. Never sold it. I still have that bar. So it's one of those things I don't really know that well. I think one of the things that is helping stocks in the U.S. is Europe just not doing very well. The economy is very weak, and there's always the possibility that there's a spillover with the Russia Ukraine war, and there's so much saber rattling um, by the Western European countries and NATO that there's this underbelly of potential contagion that makes me quite nervous. And it's possible that others view it the same. And so you move money out of Europe and bring it into the United States and buy US stocks. That may be one of the reasons why stocks are at all-time highs when you think about the CAPE ratio or PE ratios, things like that, that were or stocks relative market capitalization relative to the size of the economy, GDP, the so-called Buffett indicator, up there at
Mm-hmm.
all-time highs. So there can be that going on that would be consistent with people saying, well, I want to have some gold. There's another thing that could be going on here is that Europe is going full speed ahead with the central bank digital currency. Oh, and to the extent that you don't want to hold that, well, what might you hold? Well, you might hold some gold. Could be another
Mm-hmm.
reason why the price of gold is going up. There's a lot of reasons. When there's more than one reason, maybe it's well behaved. When you give three or four in the same direction, maybe that's why we're getting these huge spikes in the price of gold. I Intuitively, I kind of feel like we're in the seventh inning or something like that. But commodities,
Seventh inning being like late '98.
yeah. But with commodities, the big move in stocks tends to happen in the middle of the move. The big move in commodities happens at the end because the emotions are different. With commodities, it's the fear of you're never going to have any. So that's why we had like the price of oil jump to what was it, $60 to $140 between 2005 and 2008 when the peak oil theory was running rampant.
Oh
Um,
yeah.
Price of
Mm-hmm.
oil just went straight up for a while, and then, so I think we could see the same with gold and silver, platinum and palladium. That people fear if I don't buy some gold now, I never will. So the biggest move kind of comes at the end with a panic, and that makes certainly shorting commodities a very dicey affair. Um,
Um,
but at this stage of the game, um, I think there's more upside ahead. Although I could see, a pretty good shakeout and, create a little fear for the next leg up. You always need a little fear to fire up a bull market.
Healthy skepticism, wall of worry type of stuff.
Yeah,
Um, it looks like people are buying the dip today, huh? I mean, we were down and now we're back up again.
yeah. Stocks came
Not
back.
up, but we're pretty much came back to flat. We were down more than 1%, I think, at one point in the S.
Yeah, the Dow is in the black now.
Mm-hmm.
Um,
Yeah, it's interesting. We also have some events coming up, and the most important of these, I would argue, for people to pay attention to at the moment are financials earnings.
yeah, I was
We've
gonna.
got J.P. Morgan reported today, and this is sort of the kickoff. Goldman Sachs. We had been asked about this, and these are not stocks that typically move a whole ton
Hmm.
on earnings, and that seems to be the case today. J.P. Morgan. I mean, this thing moved 1.4%. This is pretty small move, all things considered, on a catalyst such as earnings. Goldman Sachs also less than 2%. But they are underperforming a little bit. Maybe not even a little bit. I think it would be safe to say that they're underperforming a decent bit relative to the S&P. what is your thinking? I mean, if where do you begin to get concerned? I mean, I have told a couple people that I didn't really think that J.P. Morgan or Goldman or these guys were really going to have material earnings results. Instead, I was encouraging people to pay more attention to the financial results of companies like Capital One.
Uh,
Because Capital One skews slightly lower in terms of the demographic, and what would be particularly interesting, to me at least, would be what they have to say about consumer credit, debt, confidence, and spending.
yeah, well, I saw secondhand that J.P. Morgan's numbers were pretty good, but they upped their reserves a little bit, which is an indication that they see some more difficult times ahead. That they think there'll be a little
Mm-hmm.
bit more defaults. This Three Colors. I don't know if you know this company, Mike, that's been in the
Oh
news,
yeah,
but they
tricolor. Yeah, yeah.
that
Mm-hmm.
they went out of business. They were a borrower, a finance company, so they borrow from other financial institutions and then lend the money to riskier borrowers. A couple of things seem to be going on. One is they had some defaults, and two, um, it appears that they pledged collateral. I've read some articles to this, don't have proof yet, that they pledged some collateral to more than one of their borrowers. One of their funders where they borrow money from. Um,
Well, wait a minute.
because
They were using the collateral to collateralize debt in more than one
yeah,
place.
so,
Ooh,
so I have read
that's.
that. I don't have the hard proof yet. That's something that'll come out in bankruptcy court as that
I did
process
see.
works through.
I did see J.P. Morgan taking a charge for that. It was a de minimis charge for J.P.
Yeah,
Morgan. I mean, something like 170 million bucks is the number I remember seeing. 170 million is a big number for a small institution.
yeah.
For a company with a more than $1 trillion balance sheet, which J.P. Morgan is, it's a nothing burger. In fact, I'm guessing that whatever their reserves are grossly exceeds whatever they set aside for loan loss reserves. It's got to
Hmm.
be so far in excess of that wouldn't even make a dent.
No, it's and they're diversified across a lot of corporate borrowers. I'm sure uh, I don't know what the credit rating of Tricolor was, but I'm confident that J.P. Morgan was earning a very wide spread relative to SOFR, this secured overnight lending rate. I don't know if they have an official loan rate or not.
Mm-hmm. Were
But
they
look at those
was
coupons.
Tricolor?
Whack.
Yeah.
So they are playing in the spiciest part of the in the market. That is for sure.
Well, this was, I guess it looks like these were auto loans. Is that what Tricolor was into?
Yeah, so they do wholesale borrowing and then they turn around and they lend money to people with very low FICO scores, or they're upside down on their cars. I've also read that something like 30-40% of all car loans are upside down. Um, and that's problematic. That you turn in your car after 3 years and you owe more on it um, than you can trade it in for, and then that
Well,
gets rolled over into the new car, and people get and the lender charges a big premium for that.
one of the things I saw was, yeah, I mean the average car payment I saw was staggeringly high, largely a function of the fact that car prices have gone up so
Yeah,
steeply since the pandemic, in particular.
and
I
rates.
was Yeah, and rates. So the combination of both of these things will contribute to that, and then of course that's going to create a huge drag on household budgets. I was particularly surprised. The United States sells a hugely disproportionate number of light trucks,
Yeah,
pickup trucks. People don't drive them. as everyday transportation in other places. But of course, there's a lot of people that use them for work and so on.
Yeah.
And I used to own a pickup truck many years ago, and I did not realize how expensive these things had become.
Yeah.
At the time, I can't remember what I paid for my pickup truck. It was about $40,000, I think. And that was it was a big pickup truck, right? It was like a long bed, 4-wheel drive, crew cab, diesel, the whole shebang. And nowadays, a truck like that, like the modern version of that, and I'm trying to remember when I bought that, maybe 2011 or so.
Yeah.
Had it for several years. A truck like that is, an $80,000-$90,000 thing.
Yeah, they're huge.
Which is just it is massively expensive, and a lot of people use those for work, and of course some of them are also much fancier nowadays than mine was. Those ones are well over 100,000. Wood trims and leather seats and fancy everything. And I see these things driving around, and now when I see them, I'm looking at them and I'm thinking those things cost almost as much. It's like a Range Rover, and everybody's driving them.
Yeah.
So I can kind of see how this somehow spun out of control. I'm not sure what happened when it became normal for people to spend a mortgage payment on
a car,
on a depreciating asset. Now, businesses, I can appreciate that. There can be tax. I'm not going to say it's a tax benefit, but the cost is mitigated by the tax treatment for a business, right? So if there was, I remember during the second Bush administration, they had accelerated depreciation for small businesses. They were trying to spur investment and spending. And I believe that some of those rules remain in place today. So, for example, if you buy a light-duty truck with your business, you can depreciate it at an accelerated rate relative to a car.
Yeah.
Right? So a considerable number of those vehicles are probably supported by that. But the curious part is that creates a market for those vehicles, and then all the people who are just buying them as their everyday transportation, they are buying a product where demand is spurred in part by favorable tax treatment for small business, which encourages them to replace these vehicles more frequently than they might if there was no tax treatment like this, right? So you can fully depreciate a vehicle in 3 years. You might replace it every 3 years.
3 years,
Whereas with regular vehicles, it's nothing like that. The business treatment for passenger cars does not keep pace with the actual rate of depreciation.
A lot of leases are 3 years or 4 years, and the reason why is a lot of times you get extended warranty service package for 3 years or 4 years. But now that the cars are highly computerized, they're super expensive to service. And so a lot of people, if they're talking about, high-end sedans, they get a 3-year lease, they turn them in so they can avoid the service costs. But then you end up having a huge depreciated value. You drive the car for 3 years. You sell it for, I don't know, half, 40% of what the original cost was. It's an expensive proposition. I, fortunately, am a car dealer's worst nightmare because
you never buy a new car.
I never buy cars. And I drive them until, you got to take it over
the wheels
to the side of the road and shoot it. And
Guy Adami on CNBC, he's one of he's a much better known CNBC contributor than I am. But I remember I was talking to him one point in the green room, and he mentioned that he continues at this point to this day to drive. I think he said it was a Chevy Tahoe that he bought back in his days when he still worked at Goldman Sachs. Now this vehicle, this thing has got to be, 20 plus years old at least. Literally driving it till the wheels fall off.
Yeah.
I at one point was that same kind of person. I had a Chevy Suburban, and I had something like 167,000 miles on it, and I finally got rid of it when I heard this god awful clanking, and it turned out that the springs in the back had actually rusted completely through, and the leaf packs were actually just swinging around in
Nice.
their brackets, and it severed actually the rear brakes. So literally until almost the wheels were going to come off. Now it's a very different thing. My wife is a realtor, and she leases a car. She replaces that car every 3 years, and actually it probably makes good sense too, because her car has to look presentable, and realtors drive a lot. They're just always driving. It's a constant thing, from one property to the other.
So,
Tucker D. Dog makes a comment here. He says, I'd have thought a few of these financials would have had breakout earnings on the backs of all these AI deals, but guess not. I guess, J.P. Morgan's numbers were good.
yeah, I think their numbers were good. They upped their do they have something for reserves on this chart? But what I saw was they upped the reserves a little bit, so that put a little dampener on it. I think Wells Fargo is probably looking pretty good right now. So I like the.
Yeah. Oh, that's right. J.P. Morgan. I was just reminded that Charlie. What was it? Javis? Is that how you pronounce her name? Javis. Yeah. She was the one that sold that. She had created a startup that she sold to J.P. Morgan, and it was actually during this quarter that I think she was convicted and sentenced. That once again, to put things in perspective, it was a $175 million deal. Again, it's a tiny amount in the grand scheme of J.P. Morgan. The company, by the way, for those who are interested, was a company called Frank. She was the purpose of this business was to, I think, help college students with their finances, find loans, do things like this. And the idea was that J.P. Morgan was going to buy this company and then essentially was going to cultivate a huge potential customer base to sell consumer products. Right? It was an interesting idea.
Yeah.
It turned out that she claimed she had millions of users, when in fact she had only a fraction of that. And so one thing led to another, and the bank realized they'd been had, and so they reported what happened, and she was ultimately convicted of securities fraud and wire fraud and a bunch of other stuff, and was sentenced. But again, I really don't think that's of any note with respect to J.P. Morgan, because again, it's rounding error. To your point, Wells Fargo, they're responding much more favorably, and perhaps the cloud has been lifted. People who may or may not remember, Wells Fargo had some sanctions placed upon them because they had a controversy of their own several years ago where they were opening up accounts for customers without the customers actually asking for said accounts to be opened. So apparently there was some kind of internal incentive or compensation scheme for employees that rewarded them if their existing customers opened more accounts. And so they started opening accounts on their behalf. And one of the penalties for this was that they were not allowed to grow their assets considerably for a period of time. And I think that has been lifted.
That was lifted this past year. So they're free to start growing again. And that's probably, sort of a loser's win here, because I think that allowed them to be much more judicious about who they lent money to, since they were not in a race to grow. And I'm going to guess that their balance sheet is in better shape than a lot of other big banks.
Yeah, this is an interesting thing, right? So J.P. Morgan absorbed First Republic when First Republic failed. First Republic had, it wasn't exactly the same situation, but they had a lot of a lot on their balance sheet in their held to maturity book, and people became concerned about it. Very low rates. They had a lot of duration inside of that portfolio at very low rates. I saw that they had a big block of mortgages that they continued to hold on their balance sheet that were at less than 2%.
Yeah.
First Republic had very credit-worthy customers. It was a bank that catered to the wealthy. But the problem was not credit. It was basically a rate bet that they had on. So they weren't facing credit issues and default issues. They were just upside down. They were loaning money at less than 2%, and they could take that to the Fed window and say, I'd like to take out money, and the Fed would gladly lend it to them. But the problem was that the amount that they were getting paid versus what they would have to pay was mismatched.
Yeah.
And Wells Fargo, to your point, because they were restricted as a result of those sanctions, was not going to need to lend as aggressively. Let me look at the balance sheet here. We can see the balance sheet should have stayed relatively constant for a number of years until they were able to sort of get things going again. And we can see that basically their commercial loan growth, there wasn't any for several years. The consumer loan growth actually declined during that period. And to your point, that probably meant that they had less exposure to some of these issues, and now they can get back to it.
Yeah.
And lo and behold, the stock's doing very well.
Doing pretty well. Yeah.
Today.
I like the company now. One of the things that I noticed on there that was their home equity loans portfolio was down. And if you're nervous about the real estate market, then you're happy that the bank did that.
Let's see. That's their.
You were at 153 in 2015. Now they're down to about 14. Auto, where did I see it? So
I can, let's see here. This is the commercial real estate loans or commercial. Yeah, I mean the commercial side, which was really more of a problem. Here's the home equity loans. Yeah. Oh my goodness, look at that.
Yeah, fell hard. So, if
also,
there's
look, all of their consumer loans were smaller. They have less in auto loans now than they did 10 years ago. Substantially less. They have less in home equity loans than they did 10 years ago. Substantially less.
Yeah.
They have less in multifamily residential. They have less in commercial real estate loans. 10 years on. Commercial loans have grown a little bit. I don't think that's much to be worried about.
No.
Yeah, I mean, so you think Wells Fargo might be JP Morgan's often thought of as being the best of breed for financials. You kind of think that maybe Wells Fargo is the best of breed right now?
I don't know if they're hard to say if they're best.
They don't have an investment banking business,
but I think they're probably a better value now than JP Morgan. I wouldn't be surprised to see Wells Fargo stock outperform JP Morgan stock for the next few years. As a result. I'm just hoping whatever management problems they had that made them do unethical things, that is flushed out of the company now completely. And one would hope. The banking industry, especially for companies of these size, and oftentimes I don't think it really makes a lot of sense for them to try to grow. You should just defend your turf because banking is so sticky. When you think about how what a hassle it is to go open a bank account at a new bank where you've got to prove who you are.
The KYC, the know your customer rules. And
where do you get your money from? And you're making a deposit of 25 grand to open the account. Where did that money come from? And all that jazz. So it's like once you got your set up, it's it takes quite an inducement to get somebody to pick up and go to another bank. Treat
Mm-hmm.
people okay, and you'll hold on to them forever. And keeping a customer is infinitely less expensive than acquiring a new one. So, um,
So one of the things I talked about on the live stream yesterday, and I want to get your opinion on this, is that I kind of feel, or not kind of, actually feel fairly strongly, this uptick that we've seen in vol, I think that folks might want to consider taking some steps, some measures to collar up or put spread collar. I use a straight collar as an example.
yeah,
Up 10, down 10, give yourself 10% worth of upside, and then buy a 10% out of the money put. If you did that on SPY as of yesterday, the net cost of that was going to be about 70 basis points between now and January
hmm,
expiration. So I felt like that was not, and that 70 basis points is offset in part by the fact that you actually get a dividend
yeah,
from SPY in the meantime, or if you have a portfolio of stocks, you likely get some dividends. I did not map out a put spread collar, but I thought I might do that now
yeah.
so that folks could get a sense of what something like that might look like. What are your thoughts on?
Well, I think if you
Um,
if you believe the market is going to continue to head higher, but we're going to finally have a correction to this equity market that's basically gone straight up. Um, the past, what was it, 12 months or longer. Um,
mm-hmm.
it makes sense to take some measures. Um, and but if a collar, you don't have to necessarily commit to getting short, or you still can have some upside into your strategy. So I think that is fine. Um,
The one example I have on the screen right now, a 600, 640, 715 is, it's like $2 at the current prices. If we get a little bit more of a bump today, that'll probably get even a wee bit cheaper.
so you
710, this, so with SPY at 665, that would give you, call it another 7% with the dividends, about another 7% worth of upside through January expiration. And in the event that you got a 10% pullback, so that would be about 598. We'll call it 600 ish. That would take away about 2/3 of your downside risk in a correction. A correction being a 10% decline.
Yep. Go
Um,
take a look at the structure again. I want to see what you did.
sure.
So we got
Just to
your long uh,
the Jan 640 puts,
puts.
and
Yeah.
then short the 600 715 strangle.
Okay. I see. Okay. Yeah, it's not.
Uh, your mileage will vary depending on the price of the underlying, but I think
It's not a bad structure if you wanted to bet on a
we've had.
crash, and because you're not really betting very much
Yeah, I
for
mean
that
it's
event,
I
and which is a
yeah,
low
I mean in this
probability
particular
event.
case, yeah, it is low probability. That's not a total crash. I mean that's a correction,
Yeah.
but that I'm if you were someone betting on a crash would buy puts that cost 34 basis points
Yeah.
over 94 days, so it's 3 months. 34
So
basis points is not a huge cost.
and so yeah, and that put that you're buying is pretty tight actually.
Yeah, I mean
As
the put
640
is
strike. Yeah.
yeah, that's so the put is 3.75% out of the money. Anyway, we have chewed up about an hour, and unfortunately, I like to carry these on as long as we feel like talking about stuff, but I do unfortunately have a meeting that I have to jump to.
Yeah. That's good.
Um, but I very much enjoyed our conversation as always, and maybe next week we can maybe we'll try to think about. I mean, we've talked a lot about gold. We've talked a lot about equities. We've provided some hedging techniques and approaches. I think maybe we should put some hard numbers on that Howard Marks J.P. Morgan conversation, which is 1, 5, 10-year returns based on valuations for the broad market over the past century. What do you think?
Yeah, stocks are not likely, statistically speaking, stocks are not likely to do very well over the next 10 years. And that'll either get corrected by just going sideways for a decade, frustrating both the bulls and the bears, or we get a washout and then we get to start to march higher again. Right now, I'm kind of in the latter camp, and I mean the former camp of sort of just a blasé market for the next decade, unless there's some kind of big kind of political, dislocation that kind of comes along. It's kind of my thinking these days. I don't know what that surprise event is going to be. There's plenty of opportunity for it. I mean, there's a lot more saber rattling between the U.S. and China, in NATO and Russia. Medvedev, came out yesterday or the day before and said nukes are on the table if the U.S. sends cruise missiles over to Ukraine. So, we're at that point in time where something stupid could happen.
Mm-hmm.
So there's plenty of opportunity for error here by the egos to get out of control.
Mm-hmm.
So if that's the case, we have the sharp down, and then we'll start going back up again. I think Bitcoin is a very interesting market right now. I think probably people were too levered, and they're getting washed out now.
Well, that's the other thing we should tackle next week then. Leverage. So we will take a look at equity market valuations, leverage, and Bitcoin.
Yep.
Tune in next week for that. For all of you guys who tuned in for this one, or who watches it recorded, we appreciate it. Like, subscribe. Send us some questions in the comments section. We space these out by week, so if you put questions in there that might require a little bit of research on our part, it's helpful to get those with some advanced timing so that we can do a little bit of work for you on that.
Yeah.
And so until next week, thanks for watching. See you next week, Mark.
Yep. See you, Mike.